All right, so if you're a business owner, you know that growth almost always means one thing, new equipment. But that kicks off a huge and, let's be honest, kind of confusing question. How in the world do you pay for it? Well, in this explainer, we're going to give you a super clear roadmap to navigate the world of equipment financing.
So, picture this. You've found it, that game-changing piece of gear. Maybe it's a new delivery truck, a state-of-the-art CNC machine, or a complete IT overhaul for the office. Awesome! But now you're staring at this wall of financing options, loans, leases, agreements. It's a lot, right? Our goal here is to cut through all that noise and give you a simple way to think about it.
And to do that, we're going to go on a little guided tour. First, we'll start at what I call the equipment crossroads. Then we'll explore the two main paths you can take, ownership and access. After that, we'll look at a really powerful tax incentive you need to know about, touch on a few specialized routes, and then wrap it all up with a simple framework so you can choose the right path for you.
Okay, let's jump right in. It turns out this whole complicated decision can be made way, way simpler just by answering one single fundamental question right up front.
And here it is. This is the big one. Everything, and I mean everything, boils down to this: ownership versus access. Think about it. Do you see this equipment as a long-term asset, something your company will own and use for years to come? Or is it just a tool you need access to for a little while, something that might even be obsolete in a few years? If you can answer this one question first, all the other puzzle pieces just kind of fall right into place.
So let's explore that first path. Let's say you answered ownership. You're looking for financing options where the finish line is that piece of equipment sitting on your company's balance sheet as an asset. Now, the most common route here is what's called an equipment finance agreement, or an EFA. And this is super important, you might hear it called a capital lease or a $1 buyout lease. Don't let the names fool you. They're all basically the same thing. It's kind of like a hybrid. It feels like a loan, but it's structured with fixed payments like a lease. And at the very end of the term, you pay a single dollar and boom, it's 100% yours.
So what's the deal here? What are the trade-offs? Well, the pros are pretty big. You own the asset. It's pretty straightforward, and you get some absolutely fantastic tax benefits. We'll get to those in just a minute. The cons? Well, your monthly payments are usually going to be higher than if you were leasing. And since you aren't it, guess what? All the maintenance is on you.
And hey, don't forget about government-backed options. The Small Business Administration's 7A loan program is a really powerful tool for this. We're talking loans up to $5 million that can be used specifically for buying machinery and equipment. It's another solid option on that ownership path. Okay, let's shift gears and check out the other side of that crossroads. This is path number 2, access. This is for when using the equipment is what really matters, not necessarily owning it outright.
The classic example here is the fair market value lease, or FMV lease. The easiest way to think about this is like a long-term rental. You make lower monthly payments and you get to use the equipment for a set number of years. And here's where the flexibility really shines. When the lease is up, you've got options. You can just hand it back, you can renew the lease, or you can buy it for whatever it happens to be worth at that time.
The number one reason people choose the access path? Lower monthly payments. It's a lifesaver for cash flow. It's also perfect for tech that gets outdated fast, because you can just upgrade to the new model every few years. The downside? You're not building any equity. It's just an operating expense. And sometimes it can be a little trickier to get these kinds of leases for used or really specialized gear. Okay, I've kind of teased the tax stuff a couple of times, and for good reason. There is a huge incentive in the US tax code that can make that ownership path look incredibly attractive. And I just love how our source material from Smarter Finance USA phrases it. They say equipment loans are popular because of a little gem called Section 179. And trust me, this is not a small detail. For a lot of businesses, this is the main reason they choose to own. So what is this gem? Well, Section 179 of the tax code is a total game changer. It lets you deduct the entire purchase price of your equipment from your income in the year you buy it, instead of just depreciating a little bit over time. And the deduction limit is massive. We're talking over $2.5 million. This can seriously lower your tax bill for the year.
And wait, there's more. On top of Section 179, there's also bonus depreciation. For new equipment, this lets you deduct 100% of the cost in the first year. The real magic, though, is that you can often combine these two incentives to create one giant, immediate tax write-off. It's a powerful reason to go the ownership route.
Okay, so we've covered the two main highways, ownership and access. Now let's just take a quick look at a couple of the side roads. These are more specialized options that can be perfect in certain situations.
First up, vendor financing. This one is all about convenience. You've probably seen it before. It's when the company that's selling you the equipment has its own financing program. You get to handle the purchase and the financing all in one shot, right there at the point of sale. Simple as that.
Now, a sale-leaseback, this is a really clever strategy if you need to unlock some cash. It works in 3 simple steps. First, you sell a piece of equipment you already own to a finance company. That gives you a big injection of cash. Second, they become the new owner. And third, you immediately lease that exact same piece of equipment right back from them. So you get the cash you need, and your operations don't miss a beat. Pretty smart, right?
And finally, what about used equipment? I mean, it's a fantastic way to save some money on the initial price, but you should know that financing it can be a little different. Lenders often charge slightly higher interest rates and prefer shorter repayment terms, mainly because the equipment has a shorter useful life left.
Woo! We have covered a ton of ground, so let's bring it all home. How do you actually make the call for your business and your new equipment? Well, here's a simple framework to help you choose your path.
This table right here, this is basically your cheat sheet. You should think about the ownership path if your equipment has a really long life, like a heavy-duty crane or a tractor, and if you really want to maximize those tax deductions. But you should lean towards the access path if the equipment gets outdated fast, think computers and IT gear, or if preserving your cash flow with lower monthly payments is your absolute top priority. It's really all about matching the financing to the type of asset and what your business needs most right now.
And that brings us right back to that single, simple question from the very beginning. So as you plan your next big purchase, just ask yourself this. Are you buying a long-term asset that's going to be a cornerstone of your business for the next decade? Or are you just getting a short-term tool that you need to get the job done for the next few years? Your answer to that question, well, that's your roadmap.